So hello, everyone. Welcome to our first panel. I don't know about you all. I'm feeling very energized after that terrific address. So no better time to talk about long-term care. Today's event brings together two of the things that are dearest to my heart, the Hamilton Project and retirement security. So needless to say, I'm thrilled to be here today. As we heard from the Secretary's comments, this issue of retirement security is obviously of paramount importance. He discussed key pillars of retirement security, including private saving and Social Security. And so while these issues are undoubtedly critical, another very, very important aspect of retirement security is long-term care. Over the next 40 years, the number of Americans needing long-term supports and services will more than double to 27 million. Spending on long-term services and supports will nearly triple to 3% of GDP. In 2011 alone, CBO estimated that roughly $400 billion in economic resources were devoted to the issue of long-term services and support. So obviously, this is a critical issue for our economy. Recognizing the importance of the issue, the Hamilton Project has put out a new paper today on long-term care insurance and long-term services and supports, or LTSS. In the paper, Wesley advocates for a novel approach to an improved private long-term care insurance market. In a moment, I'll invite Wes to the podium to give a brief overview of the proposal, and then we'll move to a moderated discussion. But first, let me quickly introduce our very distinguished panel. We have a remarkable lineup today. To my left is Howard Gleckman. Howard is a senior fellow at the Urban Brookings Tax Policy Center. He is the editor of the fiscal policy blog TaxFox. He is the author of the book Caring for Our Parents, and he is a nationally recognized expert on long-term care issues. Next to Howard is Tom McInerney. Tom is the president and CEO of Genworth, by far the largest provider of private long-term care insurance in the United States. Tom has a long and distinguished career in the insurance industry, serving in an array of senior roles with a host of insurance companies, including Aetna and ING. Next to Tom is Alice Rivlin, who often needs no introduction, but it's sort of fun to say her accomplishments anyway. So Alice is a senior fellow in the Economic Studies program at Brookings and the director of the Center for Health Policy here. She was the founding director of CEO, she was the director of OMB, and she was the vice chair of the Federal Reserve. Next to Alice is Wes Yin. Wes is an associate professor of public policy at UCLA and a faculty research fellow at the National Bureau of Economic Research. Prior to coming to UCLA, Wes served as acting assistant secretary for economic policy at the Treasury, which I believe carries the title Chief Economist of the United States, which I think is a terrific title, so congratulations on acting. Wes has also taught at Boston University and the University of Chicago. And with that, Wes, I invite you to the panel, to the podium to give a quick overview of your proposal.
Ben, thanks for that introduction, and I appreciate the opportunity to talk about this very important issue. So it might be surprising to many of you that, on average, a over 65 senior couple spends or will incur costs around $65,000 over their lifetime on long-term supports and services. There's actually a 5% chance that that couple will incur costs and spending of over $260,000. It's an enormous and shocking amount. It really represents long-term care risks, the greatest source of financial risk facing American seniors, right? But at the same time, right, public insurance, public coverage through Medicaid is actually quite incomplete, right? And when we think about buying private insurance, for a variety of reasons that would have to be addressed, right, people don't buy private insurance. So particularly for middle-class Americans, Americans who don't immediately qualify for Medicaid and don't have enough wealth to self-insure, they are ill-suited and ill-prepared for the financial risks that they face, right? At the same time, those who do rely on Medicaid, an important and critical social safety net, right, they are participating in a long-term care program that is facing increasing financial strain, right? Medicaid is growing at 6% a year for the long-term supports and services. It's a far higher growth rate than GDP, and if not addressed, it's going to continue to strain our commitments to the most vulnerable and other social objectives. So what we need action on two fronts here. We need increased risk protection for the middle class. Furthermore, we need to strengthen Medicare, not cut benefits, not reduce it, but we need to strengthen it through increased efficiency and offering the types of services that meet the needs, the various needs of Americans. So in thinking about like a reform, there really are several constraints that we have to consider. And through those constraints, it really creates lane markers for a path forward. One is that there's probably little support for a large market expansion in public benefits. Similarly, there might be a limited support for a mandatory financing program. It turns out that we actually don't need market expansion. What we don't need more financing. We need to redirect what we're currently spending in the public, through public direct spending on long-term supports and services, and what we're spending on private spending on long-term supports and services. We need to redirect that towards the purchase of more insurance, more risk protection. And to the extent that we do have increased spending, we want to have that spending be increased private spending, particularly for those who can afford it. So the proposal really has two main pillars. And I'll talk about these two, as well as a few complementary proposals. But these are the two main pillars here. One, which I called a long-term care advantage program, and it's a voluntary participation program, where in lieu of Medicaid long-term support and service benefits, the government will provide a cost-sharing subsidy for claims. It's a progressive cost-sharing subsidy, and what I mean is it can be pegged to lifetime Medicare earnings. For example, my Medicare lifetime earnings might then qualify me for a 30% government cost sharing, so that in the future when I incur long-term care support and service spending, right, the government is gonna cover 30% of that. So when I buy a long-term care insurance policy, the carrier will know that that fraction of the spendings will be covered by the subsidy, and therefore my premiums will be dropped accordingly. So there's that benefit. And what's nice about this is that it allows people to add to or top up the benefit that's provided by the government in order to buy greater risk protection above that which is covered by Medicaid. Okay, so that's a critical kind of like an architecture or a platform upon which we're going to build some other of these pillars of this proposal. And the other main one is this risk-sharing program. It turns out that carriers had the unenviable task of covering and trying to project out their claims 20, 30, 40 years into the future, where they're subject to risks like interest rate risk over that time, lapse rate, disability duration, disability rates, right? These are very hard to predict. Normally, what insurers do is they pool that across individuals. In this case, they can't do that because everyone gets hit by the same shock. It's a common macroeconomic factor, right? So these carriers really are ill-equipped to bear this risk. And so the proposal here is to say, well, qualifying risks, qualified losses that these carriers face, right, they're going to be shared among consumers in clear and transparent ways, as well as the government. And the key point here is that only qualifying losses are covered. What I mean by qualified are losses associated with unfavorable movements in these key macroeconomic financial parameters, and not the things that the carriers themselves can control. So it doesn't give rise to bad behavior on the parts of firms, like moral hazard and such. And finally, just a few things about these other complementary proposals. Product standardization, which fosters consumer choice and smarter competition. Penalty-free withdrawals from tax-advantaged retirement accounts for the purchase of long-term care insurance. That's kind of a sensible thing when we think that we need to tap this pool of retirement savings to buy the very products that help ensure retirement security. Encouraging employers to offer private insurance. And then lastly, I propose a Medicare demonstration. And the point here is that the delivery and financing of long-term supports and services right now is completely dissociated from the delivery and financing of acute and primary health care. So this is a proposal to integrate the financing to better coordinate the service delivery of long-term supports and services, as well as health care in either a Medicare Advantage or ACO mechanism. So that's the proposal, and I'm very much looking forward to the discussion.
Thank you, Wes. So let's just dive right in. Let's start with a question for Tom. Tom, in 2012, the Wall Street Journal wrote an article that said, in the prior 5 years, so between 2007 and 2012, 10 of the largest life insurance companies offering long-term care insurance had dropped out of the market, including big players in Prudential and MetLife. when you look at the demographics, the aging of our population, and you look at what's going on with healthcare, you would expect the exact opposite. So what's going on?
It's a good question, and it's a complex question, and it covers a lot of the reasons for that are, as Wes explained. So just to give a little bit of background, there are about 850 life insurance companies in the U.S. At its peak about 15 years ago, there were 130 that were offering long-term care. Today, it's about 18 that say they're offering long-term care policies, but if you look at who's really active in the market, it's 10 or 12. We're one of the largest players, but we have collectively of an industry, I would say, if you looked at all the long-term care policies sold from this industry as a relatively new industry by insurance standards. Life insurance has been around for about 150 years. Long-term care has been around 40 years. So there weren't very many good predicting tables. And for the systemic risks, very low interest rates that have been historic have really been a problem, because you typically are selling a long-term care policy to somebody who's between 50 and 60. You expect to receive those premiums and invest those. And while someone can claim the next day after a policy is issued, in most cases they don't claim until they're 80. So what you earn on interest rates over 25 or 30 years, as Wes said, you can't predict it. And because rates have been historically low, that's been a big issue. Also, lapse rates have been very, very different in long-term care policies. Again, on these old policies, in most life insurance, disability insurance, on average 5 or 6% of policies lapse each year. And so that was all taken into account by all of us when the actuaries did the pricing. And because these policies turned out to be so valuable, instead of 5 or 6% lapsing per year, it's been less than 1%. And so in the pricing, we assumed a number of people would pay in for a period of time, lapse their coverage. You'd keep the premiums and the investment income that could be spread around in the pool to pay for the policyholders who stayed. So just about all the policyholders have stayed, so that was underestimated. And then the state insurance regulatory environment has really sought to manage long-term care as a level premium product. So again, because you're taking 30 or 40-year risks, that mechanism doesn't really work. So a lot of people have gotten out. I still believe that there's a strong place for private market. Like Wes, I think that most Americans probably will continue to be covered under public programs. But I do think we need to expand private insurance. There's only about 8 million people, 8% of Americans covered, about 7 million policies. So hopefully some of these ideas that the professor outlined can help and spur more people to have some subsidies or what have you to buy more private policies. And if we could move to a regulatory regime that's more flexible, I do think over the longer run we can have more players come back into the market.
Great. Alice, can I ask you the next question? It seems from my perspective that long-term care is changing. We're not just talking about nursing homes anymore. When we talk about long-term care and long-term services and supports, what are we really talking about these days?
We're talking about a lot of different things. And you're right that what we're talking about is changing. Back in 1988, my colleague, then colleague Josh Weiner and I did a book which we called Long-Term Care of the Elderly, Who Will Pay? And this is the question we are still talking about, in case you hadn't noticed. But at that time, we thought that nursing home use would go up very rapidly as the population aged. And we made some long-term projections going into the 2020s, which is when the baby boom generation really hits the long-term care age, that projected a very heavy nursing home use. So far, that hasn't happened. Nursing home use has actually come down, not just as a proportion, but absolutely. It fell about 20% between 2010 and between 2000 and 2010. What has exploded is all kinds of other arrangements: home health care, assisted living, villages. I'm in one that mean aging in place, people coming together, mostly upper income people so far, but not exclusively, to have volunteer systems to help people stay in their homes, and continuing care communities and so forth. That is reflected in the public spending. Medicaid, as you noted, is the principal public spender, and Medicaid has an institutional bias. It's still biased toward nursing homes, but the states have moved to get waivers from the federal government and say, we want to cover home health care and other senior daycare, all kinds of stuff, that means that Medicaid now, approaching half of the spending is not nursing homes. It's these other home health and other services.
Thanks, Alice. In Wes's presentation, and Tom noted this too, Howard, that we should think about the right split between whether or not there should be a public sector solution or whether or not we should just look solely to the private sector beyond what we're already doing in the public sector. What's the right way to think about the split between the private and public sector?
So, Ben, I think there does need to be a split. But to me, I think one of the main issues here is voluntary versus mandatory. Politically, everybody recognizes that there's no political constituency for mandatory insurance. But there are some real challenges with voluntary that it's important to confront. Wes, I think, did a very good job in his paper of addressing those. But I think it might be useful to just briefly discuss what some of those are. The first thing is cost. Long-term care insurance policies, typically for somebody in their 50s, early 60s, going to cost somewhere between $2,500 and $3,000 a year. That's vastly more than people either can afford to pay or are willing to pay. To use a subsidy kind of a program as Wes described, you've got to get those premiums down a lot. Probably have to cut them in half, maybe even cut them more than that to get people to buy. So that's one challenge. A second challenge is adverse selection. The problem the insurance industry has had with a voluntary program is the people who buy insurance are people who think they're going to need it, and they're often right, and that requires more claims, costs more money, drives up premiums. There's another issue that's a little more speculative, but it's important, I think, to acknowledge, and that's about dementia, about Alzheimer's. Right now in the Alzheimer's research world, there's a lot of talk about finding ways to identify people who are at risk for Alzheimer's long before they show symptoms. And there's some possible great medical benefits to that. But it raises a tremendous problem when it comes to voluntary insurance. If I take that test in my 40s and I realize that I am more susceptible to getting Alzheimer's than the norm, I'm going to want to run out and buy insurance. Tom's going to want to know what the results are of that test. Either way, if that information is readily available, premiums are going to rise dramatically, again, because of the adverse selection problem. And the last issue with voluntary insurance is the problem of catastrophic coverage. I think many people, when they think about buying long-term care insurance, are thinking about insuring against that tail risk, that 5-year or more need. Problem is the private long-term care insurance at the moment won't sell policies that cover that risk because they've been so badly burned. So what do you do to design a program that covers that tail risk? That may require, to get back to Ben's question, that may require some government role, either through reinsurance of some form, as Wes talks about, or just a straight government program. A lot of challenges. It would be analytically much easier if we had a mandatory program, but that's not happening. We're going to have to confront, though, these issues that come up with voluntary.
So, Tom, between the tail risk and the adverse selection that Howard just mentioned, do we need a bigger public sector role in this problem?
You know, I think that it's hard to imagine that in the end, public programs, entitlement programs, probably going to cover 50 or 60% of Americans who haven't saved enough and ultimately need the care. And as Howard says, he's absolutely right on the cost. Today it's about $2,500 to 3,000 per year, and that gives you 5 years of coverage. And 30 years ago, you could probably buy a policy for $1,500, and that is what people would like to pay. And we were charging $1,500 for lifetime of benefits. So today it's $2,500 to $3,000 for 5 years. You could, however, buy less. So I think that 50 or 60% of Americans just aren't going to be able to afford private. But the issue is if you look at, and we talked a little bit about this earlier today with the Secretary and Dr. Rivlin and others. You look, there's various numbers out there, but if you add up the projected present value of costs for Social Security, Medicare, Medicaid, and the health insurance requirements for the Veterans Administration, you get various numbers, but it's around $100 trillion. And that $100 trillion is, that's the government's responsibility, but none of those are funded. So who pays for it? The government, yes, but it's really future taxpayers. And that's going to fall, and Secretary Perez talked about this on those very important millennial generation. I have 3 of them, and so I hope that I treat them well so they take care of my long-term care needs in the future. But I do think that at some point, so if there's 50 or 60 that in the end probably don't have the capacity themselves to pay, but that means perhaps 30 or 40% could, only 8% now own them. So I think there's a big incentive for the private sector and the public sector, it seems to me, to work together on programs like Wes talks about, where we can have more people than 8% be willing to buy private insurance, through whether it's subsidies or some other mechanism, having the private sector take the first loss position, the government takes the tail risk. I think there's a lot of different ways you could do it. And I think the goal for Americans, for our society, for the millennial generation, so they don't pay all that they earn in taxes to fund all these baby boomers who haven't saved enough and haven't bought policies. There's got to be a mechanism so we can at least contain the future cost of those liabilities. And that's where I think, I still think the majority of people will be covered by the public programs, but hopefully we can get more people who can afford to either put enough money aside so they can pay outright, or use the leverage with insurance to pay the premiums, and create some mechanisms, tax incentives, whatever it may be, all of which he covered in his paper, I think are all good ideas to try to increase that percentage from 8% to a somewhat higher number. Whatever higher percentage that is, I think it takes some burden off the government, which takes some burden off future taxpayers.
So, Wes, I want your reaction 1 second, but I can't let a question about budget go by without asking Alice, who's a former CBO director and OMB director. Alice, when you look at the projections for Medicaid and for Social Security and for all the major health programs looking forward 20, 30, 40 years, do those projections mean that any sort of public solution to the long-term care concern is off the table?
No, I don't think so, but I do think we have to remember that we've already made huge commitments to older people. And what we're talking about here in Wes's proposal, it's a very ingenious proposal, I like it, but it would be another commitment of public money to older people, in addition to the ones we've already made, which are going to require tax increases in the future. I don't think they're impossible. I'm not one of those who thinks the sky is falling just because the population is getting older. We're in much better shape than many other countries. But there are sort of 2 decisions to be made about whether we want to do something like Wes is proposing. One is, do we want to add another commitment to a subsidy for older people? And this one would largely serve to protect the assets of the middle class who would otherwise spend their assets, and if they had to, be covered by Medicaid. Protecting the assets of the middle class is a worthy objective, but this might not be the most advantageous way to do that. The next session is going to talk about increased savings and that sort of thing. So you might want to do it in a more generalized form.
Howard?
So I think there's a couple of ways to think about this. One of them is, and Wes talks about this explicitly in the paper, can you get money out of Medicaid? Can you find people who otherwise would have had to go on to Medicaid, who instead you can put into insurance? And can you use that money to pay for some of those subsidies? How much money is there? How much can you get? We don't know, but I think it's an interesting question. The second issue, which I think has tremendous potential, and Wes mentions it as kind of a second level alternative, is this idea of somehow combining long-term supports and services with healthcare into a single insurance program. The theory, the expectation is if you could do that, if you could provide very efficient care across the continuum, you could actually reduce Medicare costs. And that would also get you some money. Now, that's not proven. Nobody knows that. Nobody knows how much it's going to be. It's one of those things that sounds like it makes sense, but as we all know in healthcare, there are lots of things that sound like they make sense that don't work. But if it did, that would also get you some dollars that you can spend on these subsidies. One of the very practical political challenges, as Alice knows, is getting CBO to score that is not possible right now. But it's still out there, and it's got real potential.
So on the question, Wes, of looking to Medicaid for budget resources for your proposal, you had a sentence in your paper that I think importantly captures the nature of this challenge. And you wrote, most policies in place appear to address the spend-down effect, but not the second payer effect of Medicaid. So can you elaborate what you mean by these effects and why it's so important that your proposal addresses these?
Yeah, and this actually speaks to Alice's point too, and it really is a key point here. So just a bit of wonkiness first, and then we get to the issue, is that because the value of long-term care policies typically count against Medicaid eligibility, if you actually buy this plan, buy a policy, it actually delays the onset of this free coverage, and that's not a great incentive to buy a policy. So some programs like partnership programs actually address partially that issue. But there's an additional issue, which is that oftentimes when a person has a long-term care policy, at some point they actually will become eligible for Medicaid. And it turns out that Medicaid regulations say that the private plan has to pay out first, and then has to be exhausted before the Medicaid kicks in which case, if there's any potential for that duplicate coverage, that's also a disincentive to buy private insurance. So what this proposal does is say, okay, well, we know that Medicaid is a critical safety net. The public benefit is a critical safety net. We're just reconfiguring that money not to be a back-end design, but have it to be a cost share, so that it's very easy for any individual who wants to protect assets above Medicaid to do that by topping up that public benefit. And so that's really the heart of this, is to encourage that private spending. And that speaks to Alice's point, which is that we do have this money on Medicaid. Medicaid is critical, but if we're going to spend any more money, let that money be private money. And so people have that incentive to top up and pay in addition for that extra coverage to cover their assets above Medicaid eligibility levels. So that's really the heart of the additional spending, is the private spending. We're just creating a path for that public spending to allow for that.
So, and Tom had mentioned at the beginning that 8% of elderly Americans, or all Americans, carry long-term care insurance.
8% of all Americans.
8% of all Americans. Elderly Americans are more like 12%.
Correct.
When we think about the trade-off between people who are covered by Medicaid and people who need some insurance market, who can't self-insure on the top end, what's the magic number here? How many people should be carrying long-term care insurance? Is it 20%? Is it 15%? Is it 30%? How far away from the optimal given our current setup?
Well, let's put the percentages aside and say the way I look at it, there are 115 million Americans today between 40 and 75. So that's the broad universe of who should be considering it. Most people, if they buy between 50 and 60, and so and today, if you're 51, 69, you're the baby boomer, so there's 78 million plus or minus of those, and so it's a lot of people, and there are only 7.5 million Americans, of whether it's the 115 or the 78, that have policies. And so there's a big number that are not protected. And my view is, while we ultimately need Medicaid as a social safety net, let's say it's going to have to be there for 50 or 60, and we can talk about, is it a second payer or a co-payer? But I think the more of that 115 million or the 78, there's some number, 30 or 40% of those, who I think could afford the policies. They just don't. And they don't for a lot of reasons. Some think, well, I'm never going to have a problem, even though, HHS would say 70% of Americans who reach 65 will have a long-term care need. Now, it may be a small one that's easily, but it could be a long one. Our most expensive, we've paid 200,000 claims in 40 years, a little over 10 billion. Our longest claim is $1.5 million. The eldest person on claim was 109. The youngest person on claim was 27.
Sorry.
Yeah, and so I mean, and the other thing about Medicaid that I worry about is, so it's an unfunded entitlement. It's funded by payroll taxes, and today, and this is before the oldest baby boomer is 69. You can have a long-term care claim at any time, but usually when you hit around 80. The average claim is 79, but let's round to 80. So we're 11 years away from baby boomers turning 80. There are 10,000 baby boomers turning 65 every day to 2030. In 11 years, there'll be some number that I think 7,000 or 8,000 baby boomers will be turning 80 every day, and that will last for 18 years. And today with the baby boomers, the oldest is 69, 11 years away from 80, 25 to 50% of state Medicaid budgets go to long-term care. And the program it's really a welfare program designed for the poor. So you already have, let's take the average, it's a third of Medicaid already goes to long-term care. And that's before all these baby boomers who haven't saved enough, most of whom don't have policies. And so I just don't know how Medicaid survives without enormous tax increases. And unfortunately, I think those tax increases will fall on the workers. I mean, I have a little, I think the Hamilton Project's numbers are perhaps better than mine. Secretary Rubin said there's 4 workers to retiree. Those of us from the private sector, our numbers, I don't know why they're different. We're saying it's 2.9 to 1 today. But by 2030, when the baby boomers are sort of all over 65, it's going to be closer to 2 to 1, or maybe your number is 3 to 1. That's not good. And how you cover, and those workers, so let's say, we'll use your number and say in 20 years it will be 3 to 1, which I think it is today. Those 3 to 1, they have to cover Social Security, they have to cover Medicare, they have to cover Medicaid, and they have to cover the Veterans Administration, and then whatever else we spend on defense or any of those other things. So I just don't see mathematically how it can all work. And that's why I give a lot of credit to Brookings and the Hamilton Project, because one of my frustrations, and I've been working on a lot of these programs, entitlement programs and long-term care and health insurance for a long time, but it is, we've been able to avoid the big problem, and it may not, hey, miracles happen, it may not be that big of a deal. But I think in 10 or so years, I think it's going to be very, very hard to manage all these programs. And so, again, coming back to my point, and I think Genworth's point, maybe the private sector's, is we're not going to cover everybody. We don't have enough capital. There's enough players in the market. But the more we can cover, at least take some burden off these public programs.
Alice, did you have a response?
Not a response exactly, but we talk about Medicaid as if it were a program. Yeah. It's not. It's 50 programs, right. And they're very different. Right. And another way of going at this is to think about what to do about Medicaid and whether perhaps the long-term care part of Medicaid should be federalized. And some way merged with Medicare.
Yep. If you look at CBO's estimates, and this is a question for all 4 of you, should you choose the answer. If you look at CBO's estimates of the economic resources devoted to long-term care for elderly people, they say it's roughly about $400 billion. But that's split roughly half and half between formal care and informal care. So there's enormous informal care cost. People who serve as caretakers, perhaps in the middle part of their peak earning years, Perhaps not for, maybe they're taking a wage cut because they see some sort of benefit to taking care of their parents. Does the fact that we have such a high informal care cost bolster the case that this needs to be a government-run intervention?
Well, it bolsters the case that people should be purchasing some sort of insurance. This is one of these classic pay me now or pay me later stories. As Ben said, you know, the vast majority of long-term supports and services are provided by family members. Probably 85% of people receiving long-term supports and services, as Alice was saying, are getting them at home, and probably 85% of them are getting their care only from family members. So who are those family members? Or occasionally spouses, but they're most often adult children, usually adult daughters, who are taking time out of work. There's research out there that suggests that a 50-something woman who leaves her job to care for an aging parent, will lose $300,000 in lifetime income. So you think about that cost versus the cost of insurance, or frankly, the cost of paying more taxes for a public program. And either way, it might be a more cost-effective solution to insure against this risk. But that's not the way people think. And one of the challenges that I think everyone involved in this talks about is how do you improve public education so people understand those kinds of trade-offs. And frankly, the insurance industry has been trying for 40 years to get people to understand it and hasn't figured it out. But that's a huge challenge. These are real trade-offs. It's real money that eventually comes out of people's pockets.
Yeah, I totally agree with what Howard said. And also, there are a lot of women in this audience, and I have 3 daughters and 3 sisters. So come from families that are very women-oriented. But there's something that maybe is something for you all to think about. Is 51% of our paid claims go to dementia-related diseases. And those tend to be, it's only about a quarter of the claims, but 51% of the claim payments, because those tend to be longer and more severe. It is, in many cases, in the past, people bought couples policies. And it's a fact that of those caregivers, it's either the daughters or a female spouse, because it is typically, men get sick, we're sicker and not as healthy. We do bad things, I guess, when we're living. But we tend to have the dementia or the long-term care need first. And so it's usually the spouse or female daughter, so they're the ones who are giving up the jobs to take care of it. And if they do have a policy, a lot of times, if it's a dementia policy, the whole policy goes towards the male spouse. And then 71% of the claims are claims for women. And they usually are much later, really into the 90s. So again, it's also beyond just a general issue. It's an issue for who are the caregivers. They're giving up their jobs, and they're also going to be asked to pay the taxes to fund these programs. And then I think you put is particularly so half, as I said, half our claim payments go to dementia and Alzheimer's, and we understand and see day to day the beyond the economic give up. The spouses and daughters or the children are also dealing with these dementia-type diseases that are very emotionally heartbreaking. So it takes a huge personal strain on them. And so, again, I think there's a lot of issues around that, but I think we're going to have to ultimately solve that problem, too, is how do we give these family caregivers, we sort of want them to continue to do it because it's free, it saves the government a lot of money, Medicaid a lot of money, but at some point we're putting an extra burden on them that is both financially an issue as well as emotionally an issue. So I think that's also a tough part. The human element of that doesn't always get seen because we tend to look more of it as a pure economic problem.
So Wes, your paper, everyone up here has complimented it. I think it was an incredibly ingenious way to look. But so the Hamilton Project has put out maybe 50 papers or so, and I've read them all. This is probably the most complex one that I've read. And so I suspect what happened is, as you were drafting it, this is my assumption, that you start off with a simpler concept and then got a lot of yeah buts. And so you had to address the yeah buts. This is why it's so complex.
That's right.
What is the central, what was the central motivation behind the solution you came up with, which was really twofold? It was essentially the third basket was a whole bunch of other things which might help, but centrally you had the risk sharing between the government and insurance programs, and then the LTC Advantage program, which was the cost sharing subsidy.
Yeah.
So if you were going to describe the central challenge you were trying to solve, what is it?
It's the point that Howard raised earlier. It's this issue of voluntary or not. And I view this issue as, if you don't have a mandate for the financing participation, right, you have a voluntary program, and it's all the issues that Howard raises. And what it comes up with is, I always view this as, I had it up in the slides, you're dealing with like a water balloon. You're like squeezing a water balloon. You squeeze one hand, there's issues of adverse selection. In order to control adverse selection, you need to limit coverage, perhaps the people who need care the most. And where people don't want to contribute, you need them to contribute, so you need to give them incentives and subsidies to contribute. And so that raises costs. So it turns out that if you have a voluntary program, you have to trade off market stability, coverage objectives, and spending objectives. Once you push on one, you gush out the other. Once you push out the other, it gushes out the other place. So the idea is to come up with a way to try to make this a voluntary program that's not a big budget spender, but also allows people to take money that we currently have that we're spending on direct cost, meaning if I need long-term care supports and services, public, and I'm paying privately, there's public spending. A person who doesn't have it incur in these spendings pays nothing. What we want is to take that same money and just contribute to everyone having insurance. And so that's really the idea here.
Yeah, I would just add, Ben, the whole concept of any insurance is there's leverage in insurance. So if you don't have insurance, then you need $1 to pay $1 of claim in insurance. It's usually about, for long-term care, it's usually about $6 or $7. $1 of premium usually pays for $6 or $7 of benefits. So you do get the leverage if you have a policy.
So Alice, Tom, Howard, just sort of building off Wes's answer, let's say the president or the vice president asks you, it says, look, we're going to hold spending constant, and how can we better support this market? And is Wes's approach, which was basically the public cost sharing subsidy and shared risk between the government and insurance companies, is that the right approach? Is that the way we need to take if we're going to hold public spending constant?
Well, this doesn't hold public spending absolutely constant. It's not very expensive because it reduces Medicaid costs.
Yep.
But if you're going to subsidize people to buy insurance, it's going to cost something. And so I think the question is this where we would put the marginal dollar? And I think it's an attractive proposal, but I wouldn't buy it instantly.
Okay. Howard? Or Howard and then Tom?
Yeah, go ahead.
Yeah, I think it's probably part of the story. I suspect that a real proposal would require more incentives, not just subsidies,
Yeah, sure.
but other incentives to encourage people to purchase. I've been working on a project where we've been looking at some of these other incentives, and in each of them kind of get you a little bit of additional reduction in premium, but it's probably going to take quite a lot of these incentives and disincentives in combination to really get enough people to participate to make this a policy solution.
Yeah, and one thing that was in the paper that we didn't chat about here, employers offer like a great platform for offering insurance. I mean, I think if we didn't have, employer-sponsored insurance, I'm sure our health insurance coverage would also be lower because of that too, because people just, we'll talk about it in the next panel also, defaults and just having that platform right there and just signing up for benefits at your job offers a nice way to have these products in front of you and educated about the risks and so on and so forth. That's an additional incentive that could be integrated into this proposal. I kind of paint some broad strokes here about that, but if that were to be fleshed out in detail with specific incentives, how to get employers to both offer and encourage individuals to take up that insurance through the employer setting, I think that could really go a long way here too.
Yeah, I would say, Ben, if I was advising the president or the HHS secretary, it would be, look, the federal government or the states are the payer of last resort. They're going to pay for most of these baby boomers for a lot of different reasons. The more you can do, and I think Wes's program does this, to encourage more people to buy insurance, to use those leverage dollars of insurance, the dollar for 6 to 7 of leverage of coverage. The more people you have with private coverage or setting aside private funds, and as Secretary Perez says, the Vanguard accounts, it's also fine too. But I do think that we've got to have, for those, and it's less than the majority of baby boomers, for those who can afford to pay either some or all the premium, to give them incentives so they actually buy a private policy. So at least for them, whether it's 20, 30, 40% of the population that have private coverage, it takes that burden off the government. So I'm a supporter of Wes's program because I think it would increase the amount of private coverage. And I think there's no way that isn't good for everybody.
So we have just a few minutes left. We have a few questions from the audience. We'll try to get to as many as we can. The first question, I'll paraphrase here, is part of the problem just that people are demanding the wrong structure of insurance, and are they just buying it too late? So could we solve this problem by the adverse selection problem by having people buy the long-term care insurance earlier in their lives, not the 50 to 60, Tom, that you talked about, but in their 30s and 40s? That's question one. And are they just demanding a type of insurance which is just too expensive? Should we just be looking at catastrophic care with a much longer elimination period? So that's the question. Are people just demanding the wrong type of insurance?
I think the earlier you buy it, the cheaper it is, because if you really look at it, the insurance companies are building a pool based on the premiums and the investment income that they'll collect over 25 or 30 years to be paid to a certain number of policyholders. So by coming in earlier, then you're going to pay the premiums for a lot longer. They can be a lot less, so you can spread the costs out more. I do think that in the good old days, probably before about 2005, you could buy an unlimited benefit. So the insurance companies were taking the total risk, and they turned out to be a lot of problematic because a lot more people were needing those large amounts of coverage. So I think you can make it more affordable by having, and this is maybe a little bit different than Wes's program, where you have the private insurers will take the first loss position. Well, you buy a lower amount of insurance, so it's cheaper. Buy it younger, it would be cheaper, even more. And then it will cover you up to $150,000, which would cover most individuals, and then the amount over that goes to Medicaid. So there are different ways to do it. I think that we do need to look at the insurance mechanism model. The one other thing we need is, let's not try to predict interest rates for 30 years. It's pretty hard to do that. Secretary Rubin may be able to do that. I can't. And you can't predict lapse rates or inflation costs. So if we could re-rate more often, so if we do have to raise premiums down the road, we do it with small amounts versus say having to do larger. That could help as well, I think.
So we have just one more minute. Let's go Howard, and then Wes will give you the last word.
So I think it's delusional to think that people are going to buy this insurance in their 20s or 30s or even 40s. That they're going to spend their money on paying off their college loans and buying a house and buying life insurance and buying health insurance. This is the last thing on their mind, and they're not going to do it. I think in terms of the structure, the idea that intrigues me the most is this idea of fully integrating, as I said before, long-term care and healthcare in a single risk-based policy. It's got enormous potential. It totally changes the model of long-term care insurance from a life product to a health product.
Right.
But I think it's got tremendous potential.
Final thoughts, Wes.
Well, Howard, my final thoughts were the same as your final thoughts, which is that, going back to your earlier question, it turns out that the cost of 1 year of nursing home is the same for someone who's wealthy as it is for someone who's poor. And it turns out that, we can restructure these products as much as we can, but it's going to be unaffordable for some people, right? And it's going to be affordable for some others. And so what do we do? So this has been a middle class, most of this proposal has been about middle class risk protection, but let's not forget about Medicaid and seniors who have low income, low assets, low wealth, who Medicaid is facing these fiscal pressures. One way to approach this is to try to better integrate this health insurance and long-term supports and services delivery. And that could be a way to make the program much more efficient And that's the direction we need to go to make Medicaid stronger.
Thank you. And thank you all for a terrific panel. Transition, Laura, to a break, and then we'll have the second panel. Thank you.